Hello, everybody. Good afternoon, good morning, wherever you are around the world, and welcome to this week's edition of Captive Review's virtual symposiums. Today, we're going to be focusing on the insurance and runoff and legacy solution part of this industry. I'm Nick Morgan. Many of you will know me. I'm the publisher of Captive Review and have been for most of its life. And this week's session, we're very pleased to welcome long-term friends of the magazine, our sponsors R&Q, and relative newcomers to us, but not less important, Fleming Re. And this week we're really happy to announce our partner firm, who is going to be AirRock. So just a few bits before we kick off. Firstly, the session will be recorded, as it is every week. And should you want a copy of this recording, we'll send you this soon after the session is finished. And if you'd like to get slides from today's session, you're more than welcome to download these, and you can download those as PDFs from the control panel. So again, as with these sessions, if you've been listening in the past, you'll know that we use Slido, which is accessed through slido.com. And by visiting slido.com, you can pose a question to the panel at any stage you want. You can post it, and we encourage you to use your name if you can. If you want, you can ask the question anonymously, that's fine. But go to slido.com, and then you simply enter the code, which is #CaptiveVirtual, and this will be on your screen, as you can see now. So we're going to start off today with an interview today with Paul Corver from R&Q, looking at managing and restructuring your runoff liabilities. Some of the keen eyes may have spotted we had a slight misprint on the agenda, so what we have live now should make much more sense to you all. The second panel will transition over at around about 3:40 or around then, and we'll work with Fleming Re, running through a case study looking at the runoff solutions to fund new lines of coverage. So to kick us off, I'd just like to introduce from AirRock, our co-host today is Caroline Fahy. Good morning, Caroline.
Hi, Nick. How are you?
I'm very good, thanks. How are you?
Very well.
You coping with the new world craziness?
Yeah, of course, doing the best that we can here. You know, personally, I'm all safe. My family's safe. That's what's important. We're not tripping over each other too much in our space. And, you know, I've worked really hard to make sure that we're sending out communications about AirRock, trying to pivot AirRock a little bit to make sure we can still serve our members in the industry the best we can, given the situation.
Perfect. Well, I'm extremely pleased that neither of my children have appeared in the background of this video meeting so far. So with no further ado, I'd like to hand over for you for the first session for today. Thank you. And introduce Paul. Do you want to put on your video, Paul? Over to you, Carolyn.
Thank you so much. I really appreciate it. And, you know, appreciate Captive Review allowing AirRock the opportunity to partner with you on this today. You know, just for anyone who's on the line who might not know who AirRock is, we are really the only US-based association representing the legacy sector. We have, it's a corporate level membership. We have great diversity in members, from insurers to reinsurers, legacy acquirers, brokers, insurance departments. Really, the people who come to AirRock are really the true players in the legacy industry. We serve the industry by offering events a year, usually 6 or 8. Usually they're in person, but this year a little bit different. As I mentioned, we are doing some webinars. One of the things I got to push a little bit, we have coming up our Runoff Deal Market Forum. Registration is open, and that's going to be virtual this year. So that's one of our key events that we do every year. The membership is comprehensive, and we have a lot of different topics and things that we offer. Many of our members do have expertise with captives, both R&Q and Fleming Re, in working with us today. And Captive Review, you know, are both members of AirRock and regular participants. Paul, I'm going to, with that, get you to introduce yourself and talk a little bit about R&Q and your background with captives.
Hi, thanks, Carolyn, and good afternoon or good morning to everyone. Okay, so I've been working in the runoff space now for 30 years. A lot of that time has been spent predominantly in the sort of commercial P&C sector, working with companies that are either insolvent or in insolvency, or are solvent but have issues with handling and managing their liabilities and looking for strategies and structured solutions. For the last 12 years, I've worked at Randall & Quilter, who in themselves have been going for 30 years. And we're one of the first companies really in the market to start acquiring and taking on legacy liabilities from companies that were looking to dispose. And in the early days, that was historically around asbestos liabilities, pollution, and some of the other toxic torts emanating from the USA, at a time when people and companies were generally in denial about runoff because it was associated with failure and toxic elements. And in the last 30 years, have seen a complete market change. Similar to Carolyn with AIROC, I was the chairman of ERLA, which is the UK and European body for legacy and runoff practitioners until last year. So I was chairman for 10 years. And that has also seen a massive change in how companies assess runoff and the nature of how to extract value, or at least handle better those liabilities that are in runoff. And it really only started in the captive space in the last 10 years when we undertook a transaction back in 2009 to acquire the Guernsey captive of the failed Woolworths retail group in the UK. And at the time, the liquidators, who were gathering as much asset as possible for the creditors, could see that they had this offshore captive that had surplus capital in it because it obviously was well capitalized and had the solvency requirements to meet, and decided that they needed to get that capital back into the parent in order to distribute it to creditors. And so we acquired the captive, and that started our journey really of runoff in the captive space. And there'll be some slides later on to give you an idea as to sort of the numbers and types of transactions and the jurisdictions that we have that we've accomplished. But for the moment, that's really just an intro from me. Delighted to participate and work again with Captive Review. Normally, I'd be standing in a room full of people or sat around a round table talking. So it's quite odd sat at home in my study doing this, hoping, like Nick, that I don't get interruptions from my children. But as they're in their 20s, then I'm really expecting it'll just be to bring me a beer or a cup of tea or something. But we'll see where we go.
All right, great. Thanks so much, Paul. If we could go to the first slide there, we'll piggyback a little bit on what Paul just covered about the size of the runoff market. I think it's really important to look at this a little bit because there is a sort of a stigma, and as Paul alluded to just a little bit, people think the runoff market are the companies that are going away, that are not going to be there very long, that it's not really a big part of the insurance sector. But here you look at the data, the numbers support that that's not the case. This comes from a PwC survey that AIROC has done in conjunction with ERLA, as Paul mentioned, which is basically, the two organizations aren't related, but AIROC's counterpart in the UK. 791 billion worldwide global non-life runoff liabilities, large amount. You can see that. I encourage you to take a look at the survey if you'd like to see more. There's a lot of really interesting data in it. If you want to go to the next slide, this just gives you a little bit of a sense of the reasons why a company might want to enter into restructuring or runoff activity. Really simply put, today's runoff is yesterday's underwriting. Any insurance company has runoff, captives have runoff. The definitions really vary. It's very diverse by company, depending on how they handle it and how they deal with their runoff specifically. There's varying reasons a company might put a block of business into runoff. Unprofitable lines, change in business strategy, just capital deployment. You can also be put into runoff by a state regulator, where basically you're under regulatory order to finish up. There's a distinction between voluntary runoff, which is what we're really going to talk about more today, and where a company chooses as part of its portfolio strategy to put part of a business into runoff. An involuntary runoff is something that the regulators come in and take over. Dealing with runoff and legacy liabilities is really well established in the traditional insurance space, as Paul said. He's been involved in it for many years. AROC's been involved for over 15 years as the association for the US body. But it's really not as well established in the captive space. As Paul mentioned, we've seen rising interest in it, and we continue to think we'll see rising interest in it. One of the things to remember, there's 6,100 single parent captives in existence globally. This was from an AM Best study from last year. As many as 20% of them may currently be dormant, and there could be capital that could come out of that for the captive owners. One of the things too, and I'm going to turn it over to Paul here, it's not just for captives that are in runoff, captives that are active, captives that are owned by very large companies. There might be lots of reasons strategically why you might want to look at runoff options.
Sure, thanks, Carolyn. So yes, and going back again, just in time, the history of runoff tended to be related to companies that had ceased underwriting and were in runoff and were looking for exit. But a lot more recently, we are seeing companies, and that's not just in the captive space, but in the corporate world, disposing of books of business, getting security through reinsurance against any economic shocks to books of business. Zurich is a big player in this market. They have transacted and disposed of very large books of business, whether Australian Motor, German Architects and Engineers, more recently 1.6 billion sterling worth of UK employers' liability is being disposed of to the runoff community. So whilst it used to be about disposal of the end-of-life captive, now it's very much more about effective management of those on-balance sheet liabilities and the capital that is trapped against them, whether that's to meet capital requirements by solvency rules in your local jurisdiction, or whether it's because there is excess capital trapped in collateral supporting the front companies. And we tend to see in Europe per se, where we have Solvency II, there's obviously quite stringent capital requirements. Captives offshore might say, well, we don't have those same capital constraints. We're fairly capital light, except they are then sitting behind front companies who are issuing the paper, whether it's workers' comp or commercial auto or whatever, they're issuing paper, and those front companies want the protection from their reinsurers through the form of collateral. So a key activity now, especially in the last couple of months with the increasing impact of the COVID-19 lockdown, is on capital efficiency and the ability to extract and better use that capital, either to go back to the parent who may be suffering financially because of the lockdown, or to support new underwriting activity in the captive that the parent might want to put in. For example, business interruption. What is going to happen in that sector with pricing? What's going to happen with the ability to even get cover? If there is a new body set up in the US similar to TRIA that will mimic the cover then for business interruption coming out of pandemic, I think they're calling it PRIA as a potential, you could access that through a captive and therefore put liabilities in the captive, but you may need to have capital. So why not recycle capital that's being held against liabilities that are no longer much attraction to you and use it for something that's going to be a lot more worthwhile? So those are sort of reasons that we believe are coming to the fore now. Historically with deals, we have seen a lot of activity coming out of corporate M&A itself, where two large organizations come together and they have surplus captives. They do a bit of reorganization themselves and then dispose of what they don't want. On the converse of that, where corporations have disposed of operating units but are still carrying the liabilities in their captive, we're able to come in and provide a reinsurance or other solution in order to take away those liabilities, so they no longer have the distraction of claims arising from business that they no longer have as an operating unit. So if we can go on to the next slide, please, just to highlight the types of transaction structures that can be used. And Carolyn, feel free to come in if you have any comments, obviously from your experience in this regard and all your wide membership.
Yeah, definitely. Can I just really quick, Paul, just remind everybody that if you want to submit questions, I don't know, the captive review folks asked me to do this. If you want to submit any questions, please submit them on the Slido app, which Nick introduced there at the beginning, and Paul and I will do our best to get some of those at the end of this.
So very briefly, the sort of the exit mechanisms that are available, and I'm aware that Eric will touch on these as well in his session shortly. So a bit of sort of repetition to really drive home the potential in this marketplace. Straightforward acquisition. So that really is where it's an end-of-life captive or an entity that is no longer used by a corporate group that has perhaps surplus captives. And that's just straightforward acquisition of the shares of that entity. So the buyer, whether it's R&Q, Fleming Re, whoever else, take on lock, stock and barrel the obligations of that captive. Generally, captives are pretty plain vanilla companies. They very rarely have employees or premises or contractual obligations. So they're quite straightforward to look at and assess from an acquisition perspective, unlike where we're going in and buying an existing insurance or reinsurance company that may have staff and offices and contracts with IT, suppliers, etc., etc. So acquisition is relatively straightforward. It will, however, require regulatory approval. With the change of control of any regulated insurance entity, the regulator will always need to provide that change of control approval. And we have experience of that across many jurisdictions, which you'll see in a later slide. Some regulators more reactive than others, but generally we have good relationships. An LPT, loss portfolio transfer, or a reinsurance is just a mechanism to really offlay the economic risk and the volatility around liabilities. So perhaps you have a book of workers' compensation liabilities from many years ago, claims that are on a long-standing regular payout pattern for meds and perhaps follow-up treatment. That might deteriorate. There could be inflationary issues in the US especially. There could be new treatments that come out that then are afforded to the claimant, but obviously carry a cost. But to get economic certainty over that, then we can provide a reinsurance to take that risk away. So whilst the liabilities remain on the captive's books, we are actually taking the economic risk. Where that captive has faced a front company and has collateral, we would also take over the collateral obligation, as would any of our peer group who operate in this sector. Commutation is the area where I think most exit mechanisms existed until we and our peer group came to the fore in realizing that the captive space had opportunities for us. And that was where a captive would simply commute the risk back to the front company. So say, for example, AIG was issuing the 10 million workers' comp policy and the captive was taking the first $500,000 of any one loss. The two parties could have a discussion over time and agree what price the captive would have to pay AIG in order for AIG to then take all that risk back on their book and not cede the first 500K to the captive. So that was quite a common way, and quite a lot of front companies are still doing that. They're still offering that commutation. Some are reluctant to do it. Some will do it, but at a price that may seem unattractive because they don't really want to do it. This is where I might upset some front companies who could be actually listening on the call. But it's always better for the captive to go out and get a competitive quote, because whilst the front company may be offering a price, they may not actually really want to do it, but feel obliged to. With less sort of limited or more limited application, novation, and that is something that we've undertaken in a number of scenarios. And novation really is the ability of the parties to a contract to agree that the contract is altered and amended and basically moved to another party. So if you have a captive sitting behind a front company giving reinsurance for the first 500K of any one loss on workers' comp, as an example, we would come in and take a novation of that contract. So the front company and the captive would agree to basically assign that contract across to R&Q. The captive then walks away as if it was never involved in the contract and as if R&Q were always there from day one. We take over the obligation for the collateral to the front company and manage those liabilities going forward. With regard to the claims handling on that and most of the other exit mechanisms, actually, I should say that we generally leave the claims handling with the incumbent TPA or the front company, or even the corporate itself. We've dealt with a number of large global corporations who have very effective in-house claims management. We're not there to disrupt that process. We will have a layer of oversight to make sure that They continue to run the process appropriately, even though it's no longer their money, but the claims handling is generally managed very effectively by the current parties, and we're not looking to upset that. A transfer mechanism is only available in certain jurisdictions. We've used it widely in Europe. There is a Europe-wide directive for transfer of business. In the UK and Ireland, it also is then a court-approved process rather than regulatory approved. And that in those two jurisdictions also allows for any outward reinsurance benefit to also transfer. In the rest of Europe, it's only the obligations that the captive has and not the benefits it has from reinsurers that transfer. Assumption, this is where we get into alternative types of self-insured vehicles, especially in the US workers' comp self-insured trusts. We have an A- rated carrier based in Florida that's admitted in all 50 states, and we have assumed by way of special assumption policies that are approved by regulators and the relevant workers' comp regulatory bodies in the states to take over those obligations from self-insured trusts. And finally, on their deductible reimbursement policy is a mechanism whereby we take on the responsibilities that a corporate may have, where they have decided to retain the deductible rather than put it in a captive. So, for example, if the front company is issuing the $10 million workers' comp policy, the corporate may very well decide that it will then reimburse the front company for the first $500,000 of any one loss. When they decide they no longer want to do that, we will then issue a policy to that corporate to then take on the responsibility for those reimbursements, and we stand behind them in funding the claims back to the front company, and we'll also put in a back-to-back collateral if they are also having to post collateral. So those are pretty diverse set of exit mechanisms, but I think R&Q and our fellow group in the runoff sector are always looking to innovate and develop, working with counterparts, working with regulators to find the best exit mechanism or protective mechanism for liabilities. And again, just to re-emphasize, a lot of what we're seeing now is from entities that are very active, healthy, ongoing captives and self-insurance vehicles, but just looking to address the liabilities of old, looking to address trapped capital in collateral, or looking just to basically prune out the dead wood and revitalize the captive for the next session and season of underwriting. Don't know if you have anything to add on to that, Carolyn, before we move on.
Yeah,
So
no, I think that was a really great overview. I mean, all these things have sort of the terminology of the runoff space right there. So ERIC has other resources, certainly, if you're interested in learning more about them. And one thing I will piggyback on that I think is particularly interesting about the runoff industry is how flexible and innovative and creative we tend to be. To Paul's point, I mean, part of it, even when you're not dealing with a captive, when you're dealing with a reinsurer or an insurer, with sort of what we would call more of a traditional legacy deal, you want to find the right partner, and it's really about coming up with the structure that's going to work best for both parties.
Sure. So could I have the next slide, please? Hopefully the typeface is not too small to be seen. It's only getting that way on my laptop, but just to give you a flavor as to R&Q's experience in the space. Overall, since 2009, we've executed 105 legacy deals across 35 different regulatory jurisdictions. And you'll see from the next slide that I don't count the USA as one jurisdiction, because clearly it all has individual state regulators who will have their own nuances and ways of doing things. So that 35 jurisdictions does include a number of different states. It's not 35 countries. But within that, we have concluded deals with 77 either captives, risk retention groups, sales within a segregated account company or PCC structure, workers' comp trusts, and other self-insurance vehicles. And the pie chart really gives you a breakdown of the types of transactions. So acquisition, the largest chunk there, 41, but that is the slowest developing. We're seeing more developing now in the reinsurance and novation areas. Business transfer, which I alluded to, is potentially a growing area now in the US, where we have some states have enacted their own insurance business transfer legislation. Rhode Island was one of the early ones, but hasn't yet concluded a deal. All eyes are now on Oklahoma, and both NSTAR, who one of our peer group, and ourselves have got applications pending with the Oklahoma regulator to do a business transfer. So that literally takes the business from one insurance company and dumps it in another insurance company through a regulator and court overseen process. So that gives full finality to the party that is disposing of those policies in that portfolio. So briefly move to the next slide, please. Conscious that time is ticking away.
Yep.
And this just really touches on the breakdown by jurisdiction. So as you can see, the pie chart on the right just covers off all the states where we have enacted a transaction, and the pie chart on the left is all the countries. So as you can see, all the expected captive domiciles are in there: Bermuda and Guernsey and Cayman and Isle of Man. Some of the smaller, lesser known, Barbados. We've done transactions in Ireland, Denmark, Finland, all over. So it really is a very global ability. We do not have operations yet in Southeast Asia or further afield. We're very much European, Middle East and US and Caribbean focus, but certainly there are some of our counterparts and peer group are very active in other jurisdictions around the globe. So Runoff really is here. It is here to stay. We appreciate that captives are run by companies that specialize in retail or transport or energy. They're not necessarily deeply involved in understanding insurance. And I think that's where the likes of Carolyn and AROC come into play as the market representative body, or companies like R&Q are always willing to discuss and convey our knowledge and experience in order to help companies determine if they should be doing something with their legacy. So I know Carolyn would be very keen to open up those sorts of conversations if anyone wanted to talk about that with someone who's not a service provider or an acquirer looking for an edge, but purely an unbiased perspective from the market body.
Right, absolutely. And you know, from AROC's point of view, we've definitely seen increasing interest from the captive space. When I started with AROC about 9 years ago now, I went to the VCIA, the Vermont Captive Insurance Association, which is one of the largest events in the States. And I went a couple of years in a row and really didn't find a whole lot of interest from the captives in learning more about runoff. So I stopped going for a couple of years. I've been going back again the past 2 years. In fact, we've done sessions like this for the VCIA, for SICA, there was one that was recorded as well, California Insurance Captive Association. You know, that's another one that I know SICA hosted one of these earlier with Captive Review as well. So all really good resources. I mean, you know, Paul, you kind of talked a little bit about sort of the benefits and how a runoff provider can benefit. What about some of the challenges? Are there's some challenges, I'm sure, in dealing with legacy deals with captives?
Yes, there are. I think one of the ones that we find is and generally we're dealing with the risk manager at a corporate who's working with the captive and looking at options. Has it got sponsorship from high up in the organization? Has the risk manager got a clear mandate to go out and do this? Because we have found that exploring transaction structures and perhaps taking away portfolios and liabilities, a lot of work goes in from both the risk manager and from us, and then it doesn't get sign off from higher up. So one clear perspective is where's that sponsorship, where's the mandate coming from? We also get faced with issues that we currently have at the moment with the COVID-19 lockdown, and quite understandably priorities and attention of the corporate owners gets distracted by something that needs a lot more time devoted to it than looking at a disposal of some liabilities in a captive. And so we've got some deals at the moment that have sort of started to go on a go slow process, and inevitably it's because the corporate owner is significantly distracted. They've got staff working from home, they may have had to shut operations, and quite clearly that is going to cause disruption. If regulatory involvement is needed for a change of control, or perhaps the approval of a reinsurance or a transfer mechanism, that can create delays. As I said, we've got good relationships with a lot of regulators. In Guernsey, we get pre-approval for change of control now before the ink is even wet on a share purchase agreement. And so there are a number of challenges. The front companies also may be reluctant to see a change in a relationship, and therefore if we're looking at a novation as a clean exit route for a captive to remove those policies from themselves and pass them over to an acquirer. That involves the front company agreeing to that process, and that can sometimes cause issues, especially if there are concerns over collateral, and perhaps the front company might want to increase collateral, or certainly may be willing to decrease it, even if it seems as though it's substantial in the first place. But there are a lot of challenges. But again, as our pie charts show you, we've succeeded in a lot of transactions, so we're pretty well versed and experienced in how to get around the issues and challenges that may be faced by the parties. So are there any questions coming through yet? We've been talking now for almost half an hour. Perhaps if we move on to the next slide.
There we go.
Here we go.
So, hi, it's Nick back here again. I'll just put my camera on. There you go. So I just sort of reading through these questions as they were coming through, and I've got one or two myself as well. But just wanted to pick up one from Rob Collins there, Paul, who asks you, do you find one particular mechanism more appealing for captives specifically? We accept that novations are gaining momentum, but they'd appreciate your perspective on this one.
Okay, thanks, Nick, and thanks, Rob. I think it really comes down to the appetite of the captive and what they're trying, or the captive owner, what they're trying to achieve. Obviously, if the captive is purely in runoff and not active, then they're probably going to be looking for a disposal through an acquisition. Although we could take a novation of the contracts to leave it there, so it has no longer has any contracts for the reinsurance or the insurance, and then they could go through a dissolution. But that seems like a longer process than just selling it outright. But there may be other matters that mean it's more appealing. I think novations are gaining momentum, but again, they tend to rely on the willingness of a front company to participate and agree to a novation. We've got great relationships with a lot of those front companies, and even we collapse deals into specific cells in our Bermuda segregated account company. So we have a cell that faces Travelers, a cell that faces Liberty Mutual, a cell that faces AIG, etc. And when we take novations from other captives or cells, we bring them into that respective cell. So we're basically amalgamating the collateral obligations to that front company. The front company has attractions to that because it means they reduce the number of parties. They're then having to assess for credit risk and collateral. So novations are gaining momentum, certainly, Rob.
And then I just wanted to ask the third one down there. Are you beginning to see that fronting companies are asking for increased amount of capital of collateral than usual?
I mean, it's clarified that if the restructuring is due to the impact of COVID-19, I think that's probably going to be a question for those entities that have active captives that are currently writing in this current period. Now, we, being a legacy acquirer, we would look to only take on policy periods and that have already expired. So it could be that fronting companies are going to get concerned with the ability of captives, but it really depends on what risk that captive was writing and whether they're going to be hit for business interruption or whether they're going to be exposed to some of the potential claims coming out of COVID, perhaps on workers' comp, etc. But we're not seeing that at the moment. What we are seeing is the potential for COVID-19 to give rise to captives thinking about more benefits of doing something, because they could free up capital that's trapped against legacy liabilities in order to perhaps face off the front companies who are asking for increased collateral or needing to recycle capital to support new lines of business to put in the captive, or as I said earlier, to repatriate the capital to parent to help them fight off financial issues they may have at the moment.
Perfect. I think that one that's just come in as well interests me. And potentially if the following complete hi guys, if following a complete sale a captive goes bankrupt, is there any recourse back to the original owner?
I mean, generally not. It really depends on the nature of the transaction and whether a liquidator or a regulator coming in can think it was an unfair transaction and therefore they can unwind it and it goes back to the original owner. but on the basis that the captive, and we would be very clear in our due diligence to make sure that we believed the captive was sufficiently capitalized and had enough asset to meet its obligations for all its liabilities going forward. We are not aware of any such failure by a runoff entity that has taken over a captive. And I think it would be a very rare occurrence to happen, but it is possible it could go back to the original owner. But a lot of the time the captive is there sat behind front companies. It's got significant collateral that is agreed upon by the front company. So you'd think it was sufficiently capitalized and asset available to stave off any potential bankruptcy. But never say never.
Yeah, and that was from Aon's Michael Douglas, that question, I believe. I've got a question for you, Paul. So you've had businesses such as, I think, AstraZeneca, Virgin, gosh, I'm trying to remember, Unilever, I think you've done some. Yeah. Well, yeah. So do you see any particular sector of business having trends towards runoff solutions or legacy solutions, or is it really like COVID, indiscriminate in where the opportunity comes?
I think it's pretty indiscriminate. It really relates to the nature of risk that was taken on by the captive. You know, inevitably the long tail liabilities are the ones that are going to be transacted more heavily because they have the longest tail, they have the potential, the most volatility over that long tail. So it's corporations that are going to have the types of volatile claims in a workers' comp environment that perhaps are the ones that will be more likely. So big manufacturing organizations, transport, to an extent we see that through commercial auto, where they've self-insured, transportation groups or departments of large corporates. But we're tending to see now more also a lot of the self-insured, the corporate deductibles I mentioned earlier, where corporations are holding that themselves. But again, it predominantly relates to the longer tail liabilities, workers' comp, GL. So no real clarification with specific sectors. It really is across the board.
Carolyn, are you seeing any changes in the sort of landscape of runoffs in the last 6 months? I guess, and particularly any effects from COVID?
I think it's really a little early to tell, on that. I mean, the last 6 months is, really, I would look back and just say we've seen a growth in members, a lot more growth in interest in legacy and runoff in general. AROC has had new members come in the past couple of years. Brokers are getting a little bit more savvy and interested in the area and serving their clients in order to sort of match, the best acquirers with their clients. But as far as COVID, I really think in the end that there is going to be a lot more activity in the space, just because companies are going to need to sort of regroup and look at how they're going to deploy capital differently related to this current pandemic.
And I guess that second question sort of touches on that really, looking at whether the insurance managers put up any resistance against the suggestion of legacy solutions being outsourced.
I suppose it's a legacy solution. So inevitably an insurance manager is not going to be too pleased if we come in and acquire a captive and then move it away, amalgamate it, transfer it, dispose, whatever, they lose fee income. But as I said earlier, we're seeing more and more transactions where it is for the health of the captive and it benefits the captive, whether recycling capital or getting greater certainty against volatility. And that's where the insurance managers really perhaps should be stepping up to the plate a bit more and working with their clients to say, okay, we're certainly now in very turbulent times. Is there something you could be doing with your captive that will enhance the whole process, that will repatriate some capital to the parent or will be able to recycle it for new underwriting? I think it's been a bit of a shock to the insurance managers at the start where they were losing clients, but now it's a different world. There are lots of clients out there that could really benefit from it. And if the likes of Zurich as a global insurer are trading away hundreds of millions of dollars or sterling of liabilities, then you have to say, okay, well, they're very, very large, very sophisticated. They're seeing benefits in doing it. Why would that not apply to us as well? And I think the insurance managers are the key linchpin between the acquirers and the captive owners. They have the better insurance experience and knowledge to relate. And I've said this to all the major captive managers, there's a real role for one of those entities, if none of the others are interested, but for one of them to really become a specialist in runoff. They will have companies going to them to get runoff experience and advice, and they could actually make fees out of managing that process for other companies' clients. So that's throwing the cat amongst the pigeons, probably.
So there's just one, I think we're just looking at time. We'll make this the last question. There was one that popped in that seemed to have popped away again, but the collateral seems to be very much the trend of the questioning here. But do credit ratings affect the collateral levels?
Sadly not to the extent that we would want. I mentioned earlier we have a US carrier that's A- rated. We also have a European carrier based in Malta that's also A- rated by AM Best. The European one gets a more favourable treatment, actually, I think, because under Solvency II, if you're reinsuring yourself with an A- rated carrier, you get very favourable treatment, better than you would if it was a non-rated entity. So if you're moving a risk from a non-rated captive to an A- rated, then that really does help remove the obligation for collateral. But unfortunately in the US, we don't see much change. So generally we would look to reinsure that or change and do the novation of that into a cell. If we've got to put up collateral, why put it into the highly capitalized rated vehicle if you've still got to hold collateral? Put it into something that's a lot more fluid and rational with regard to capital efficiency.
Brilliant. So Carolyn, you stay with us. Paul, I'd like to thank you very much for the first session of today's thing. And if anyone needs to get hold of Paul, there's contact details on the screen now. And as mentioned, there are handouts you can have download as PDFs, or you can re-listen to this again when we send out copies. So for the first part, Paul, thank you very much.
Thank you, Nick. Thank you, Carolyn. Speak
Thanks,
again
Paul.
soon. And thank you, attendees. Bye for now.
So that then leads us straight on to the second part of this, where we'd like to introduce Eric Haller of Fleming Re. And Eric's going to sort of talk us through looking at specifically funding new lines of coverage. It's very much identified in the last few years or so as the ability to release the capital and really invigor your captive programs that you have funding new lines. Someone of a captive was organizing a captive conference with myself some time back, and we mentioned inviting a runoff partner to speak, and they were very negative about it being all about killing captives down, where clearly I think this is the new thinking about captives. So Carolyn, I'm going to hand back over to you. I'll get rid of my face, and Eric, hopefully you can hear us and you're on the line. Just need to unmute if you're on. There you go.
Yep, no, I can, and I'm just hopping on video, I believe. There we go.
Hi, Eric.
Hi, Carolyn, how are you?
I'm well. How are you?
I'm good. Surviving
Great.
these new virtual times.
Yeah. So part 2 here, right?
Yep.
So you got a chance to listen to the discussion that Paul and I had. I think some good information there. And the goal really here with the second half is to, I'm sure that the listeners will hear some repeat a little bit of some of the messages that we're going to send, but it's also to turn a little bit more to a case study to give the folks on the line a little bit more, I don't know, I guess the practicality of, you know, how, if you are interested in entering one of these captive transactions, how it might work.
Yeah, absolutely. Kind of starting and drawing upon a lot of the trends that you guys have identified, and then going through it in a detail to give everyone an idea of what a detailed transaction would be.
Great.
Okay, should we flip to the first slide? Yeah, so with this, basically we wanted to look at what the recent trends are. As you guys touched on in the last session, there's been quite an evolution of the runoff industry over the last decade. Historically, it was known with a lot of insolvency issues, toxic liabilities, such. In the last 5+ years, that has really changed to providing insurance entities, captives with tools to manage their liabilities, their exposures. We've seen recently that has gone to evolve even more to different types of strategies, I guess. I know we talked about lines of coverage, but it really comes down to different types of strategies because this can be applied to all different lines of business. With that, the three things that we've seen recently, and we'll kind of take them chronologically, because 2019 there was quite a bit of M&A activity. And we saw a lot of transactions that were two corporate entities were going through an acquisition, let's say, and the acquiring company did not want to retain the liabilities associated with that previous company. So they were looking for a proactive solution to get rid of those liabilities prior to the overarching M&A transaction closing. A couple challenges with this, obviously. They're starting a overall M&A process and embedding into it a runoff transaction, which in itself is an M&A process. So there's certain concerns that they have. They want to make sure all the timelines are met. But that was definitely a significant driver. The next one is, as the insurance markets have been hardening over the last, really at the end of last year, beginning of this year, a lot of risk managers wanted to change their strategy. They wanted to increase their retentions. The challenge with those increased retentions was, where do they find the capital? They either have to inject additional capital into the captive that they have, or they have to come up with another solution. And that other solution was looking at a runoff transaction and having the transaction release a portion of unencumbered capital that could then be invested into the new year. And the last one, which I'm sure we're all very, very aware of, is the current market conditions caused by the pandemic. With any market disruption, there is almost always a need for capital. Traditionally, people will look at the normal capital markets, whether they raise equity, whether they raise debt, whether they have lines of credit out there. An often overlooked source of capital is the encumbered capital in captives. One of the things that I know you guys touched on in the last our session is, what are going to be the effects of this pandemic, and how are we going to be able to deal with them, or different companies be able to deal with them? You know, we're starting to see that first wave of people coming to us and essentially say, look, is there something we can do? We have a need in the operating company. I know people debate how long it's going to be, how much of an impact it's going to be. The International Monetary Fund released a statement recently that they're expecting this economic fallout to be the worst since the Great Depression. That seems very, very dramatic, and it could be. We haven't seen the full effect of it yet, as we're right in the middle of it. But either way, it's really just a demonstration that there is going to be a need for capital, and that the encumbered capital is a good source for that. Sorry, just grabbing some coffee. With these three factors, I think it's really a demonstration that the common attribute is the need for capital. There's been a ton of drivers, and I'm sure you've seen it. We spoke with in the last session about it, all of the different reasons for a runoff transaction. But with the current environment we're in, capital is going to be the main driver.
Yeah, and it's interesting because we've had, some interest even before this happened from AROC's perspective, and having more capital providers coming to the table and kind of being interested in getting involved in AROC as well. So I think in addition to some of the tools and solutions that you can truly offer through Runoff, there's, there are other ways that you can work with a Runoff provider to raise some additional capital through some of the capital markets as well.
Yeah, absolutely. I think we can go to the next slide. This is just a different view of the typical transaction drivers, and I know in the last session we talked about it also, so we won't spend a lot of time here, but if you look at it, it's really those 3 different buckets, whether you're looking at exposures, whether you're looking at capital, or you're looking at a restructuring of some sort. The more of these that you have, the more likely you will benefit from a runoff transaction. So if we go to the next slide, with the case study, and let's jump into that right now. We selected a case study where that main driver was a capital release to make it more on point for what we are talking about for the current market, so people can get an understanding of how they would go through this. A client we worked with came to us and essentially said, look, I have this captive that we're no longer writing business. I have a significant amount of capital locked up in it. I want to release it to fund growth in an operating company that I have. So it wasn't that the operating company had challenges. He was experiencing a period of growth, and he wanted to be able to facilitate that without having to go to equity markets, without changing his leverage ratios and bringing debt in. So he saw this as a very good way. So with that, we had a conversation. Obviously, he told us what the primary goal was. We wanted to outline secondary goals that he could also benefit from. And those are listed there: a tax efficient structure, elimination of operating expenses, full finality, and then being able to complete it by year end. So through our conversation, this is essentially where the starting point of a transaction is, identifying what those goals are and what those motivations are.
And I want to delve in with you a little bit more, Eric. I see you have full finality there in quotes. So, Paul alluded to this a little bit. You hear this in a lot of things that you read about runoff and about transactions really creating, I guess, full finality for a company. So can you just sort of delve into that a little bit more as far as exactly what that means?
Yeah, absolutely. With the different types of transactions, they all have different benefits. They all have different challenges. What full finality means is essentially getting back to the last question on an acquisition. Can they come back? So after a transaction, is there recourse, right? Can you go back to the person you acquired it from, or novated it from, or reinsured from? And when we look at these things based on the different structures, has a different, I guess, amount of finality. To make this a little more clear, for example, reinsurance. Reinsurance is the entity that is the reinsurer is still in that liability chain, right? So, for example, if the reinsurer ends up going bankrupt, the retrocessionary ends up going bankrupt, the entity that reinsured that to them is still going to be on the hook. With full finality, and let's call it an acquisition with no regulatory involvement, relatively straightforward, that entity will actually be removed from that liability chain. So in a typical captive, we have a front company, we have the captive, and then we have the runoff provider. For a reinsurance solution, all 3 of those entities will still stay in that liability chain. So although that captive may have economic finality, meaning it all goes right with the transaction, the they won't have any recourse, or there won't be any economic implications because everything is going well. There is still a chance that if that runoff provider experiences a significant amount of deterioration beyond what the collateral is for the transaction, it could go back to them because it doesn't remove them from the liability. With an acquisition, the entity is actually required. The previous owners are removed from that in 99% of the cases. And the front company will be dealing directly with that same entity, but with a new owner. So the previous owners will be removed from that liability chain. So that's the difference between what we would say economic finality would be and full finality.
Okay. You know, one of the things I did want to mention, and Paul alluded to this a little bit too, you know, one of the new developments in the runoff space, which I think has really helped bring AROC and IRLA and other groups such that are dealing with runoff to the forefront, is that in the past few years, there's quite a number of states that have passed insurance business transfer, IBT, or division laws. There's about 10 states, I think, right now that have one or the other of those types of laws on the books. And so this is a different level of finality, and that, you know, the regulators get involved in that. You know, Paul mentioned Oklahoma and Rhode Island as being a little bit of front runners on that. You know, we're all anxiously awaiting sort of the first insurance business transfer to go through in Oklahoma, because there's a lot of thought that it will really open up a lot of other options for the states, for the companies that are in the space. You know, these laws are based on the Part 7 transfer in the UK, which folks are very familiar with. It's been in place for decades, many successful transfers under that. Each of these laws has a regulatory process and due diligence checks. There's definitely, you know, they're complex. It's not something you just, decide I'm going to go, you know, do an IBT today. I mean, there's definitely a process for it. You know, the NAIC has established a restructuring working group. AROC has provided some education to them on runoff as well, and they're also working on a white paper. I don't know what the deadline on that is right now with the COVID situation. I'm sure the insurance regulators have quite a few things on their hands to deal with. You know, it is a rapidly developing area, so if there's anybody who's interested in learning more, you know, we have, through AROC, we have a website, arocmatters.org, which is our resource for searchable industry articles and updates. We've got a lot of articles on that topic that'll give you some nuts and bolts on it a little bit more as well. So, you know, if you're interested too, you could also reach out to me or Eric about that to learn a little bit more. You know, we've definitely got a lot of resources that we can help, you know, educate folks on how that works.
Mm-hmm. Yeah, and I think that's a great example, especially in the U.S. market. You mentioned that the Part 7 has been in the UK for a long time, but it's just showing the trends that there is more that the runoff market is going to evolve, and that this is definitely, I think Paul said it, that this is an industry that's here to stay, and it's gaining a lot of momentum, a lot of recognition, which has been great. Okay, let's hop to the next slide. Now with this, this is where we wanted to deal with a little bit more detail of the transaction and what happens. As I said before, with a typical transaction, we'll go through the motivations, understand what those goals are, and we'll select the most efficient structure to achieve those goals. In this specific transaction, it was a Cayman captive with a front company. So a very typical structure. When we were approached, we approached the front company, told them about the novation. One of the nuances about a novation is that you need front company approval. So along with agreeing to a transaction with the captive, understanding the needs of the various jurisdictions, in this case, we're based in Bermuda. The captive is based in Cayman, so we had to deal with both of those regulators, and we have to get approval from the front company to do the transaction. With a novation, essentially what happens is there is a tri-party novation agreement. the captive will be released from those liabilities and we will step into those shoes, meaning we're just going to assume the conditions of the reinsurance agreement that was in place with them. On top of that, we will benefit from the TPA that was in place to manage those claims. Most of the time they're paid on a cradle to grave basis, but not always. So that's obviously a consideration when looking through the transaction that we need to do. And then with that single agreement, once all the parties agree, that will go into effect. The liabilities just on line 3 will then move to Fleming Re, and the transaction will be completed. I know collateral was had a couple questions associated with it in the last session. Most of the time, again, most of the time, we are in uncertain times now, but most of the time, the collateral will just be assigned and it'll be at a sufficient level. There may be instances where there is a distribution because of excess collateral. There may also be certain situations where there's a small top up. And that's where the communication through the whole process really makes it a lot more smooth between all parties to establish that up front, so there's no surprises at the end. With this structure, what ended up happening is we were able to release a significant amount of capital that was encumbered to the captive owner. And again, if you remember, that was the primary goal, to invest in the operating company. We were also able to do it on a tax efficient structure. We were not giving tax advice. This is the captive owner's tax advice that he received, and we were able to structure it in a way that satisfied what he needed. With that novation, he was able to shut down the captive, thereby eliminating the operating expenses. And we were able to complete it on the timeline that he had, which was prior to year end, because he wanted that transaction to be in a certain taxable year. If we hop to the next slide. So with this one, collaborate for success. The biggest takeaway, and everyone can read through the different items here, but really the overall concept of this is that you should be doing the following to help ensure that a transaction will satisfy the goals of all parties involved. It's really as simple as that. If we go to the next slide. With this slide, we have, labeled pros and cons of transaction structures. It's really just differences between those. This is very similar to when Paul went through all of the different types, and we won't go into that level of detail. I think the main thing that I want to highlight here is that if you look at the chart, there is not a single transaction that satisfies every single goal. So it is important for both the people seeking a runoff solution and the service providers to recognize this and make sure when going through a transaction, they select a structure that is aligned to their goals to make sure it is a successful transaction.
Yeah, and one of the things that I'll add to that, I think that's a good overview of sort of the different pros and cons. As we heard, Paul went a little bit more into detail about what each one of those things means. One of the things that I like to tell people related to runoff transactions is, when you've seen one transaction, you've seen one transaction. They're basically each different. And as unique as the companies and the parties that are involved in them. I mean, there's the creativity and the flexibility to work together to meet the goals of the parties. So, there's different appetites out there as far as companies and the size of the deals they're interested in. There's different companies as far as their different levels of expertise. So it's by no means a one size fits all type of exercise. I mean, working collaboratively, I think, is one of the keys to success, as which was on the previous slide as well.
Yeah, that's absolutely true. Okay, with the, let's go to the next slide. So challenges with runoff transactions. This is, there is a bit of repetition from the last session and from everything we've been talking about. The real challenge is making sure that interests are aligned, making sure that the right parties are selected, making sure that what you want to achieve is achievable with a runoff transaction. Really having realistic expectations and goals in the current structure, timelines, and then making sure you have a runoff provider that can achieve all of those things. And if we go to the last slide, this is where we just want to talk about some success stories. Basically to give you an idea of, if we have over on the right, the success stories there, give everyone an idea of what different types of motivations people have had for transactions, different types of goals, how they're viewing it, and what was able to be done. The first one is the case study that we've been talking about. Capital release to fund the operations of a company. Very common goal. It's going to be much more common, I believe, in 2020, given the current situation that we're in. But it's also very achievable. This is one of the primary goals of runoff transactions, especially in the more recent trends. And we're able to provide that. The next one, group captive finality solution for all members. We were approached by a group that had 19 different members associated with it in a group captive. Now, the fundamentals behind the transaction are exactly the same. The biggest challenge with this is getting 19 people to agree on the same terms for a transaction. It was outside of that, it was a relatively simple transaction. We had, at one point, I think we had buy-in from half right away, and then we got to 18 people all bought in to this one transaction. And we had one holdout. It was a small issue. It was really just a communication issue and making sure that they did understand it. And we were able to solve this by obviously having a conversation with them. But I highlighted this to show there are other challenges outside of just the typical transaction issues that we're talking about. When you're dealing with multiple parties, it makes every transaction a little more challenging. It can definitely be managed though, and as a result of this, all parties walked away happy, so that was good.
That's great. I mean, and I, yet again, I think, one of the things that AROC provides is sort of, at least in the past, pre-COVID-19, has been the benefit of folks getting together in person and being able to, meet with parties, counterparties, potential people that they could deal with. All of our attendance lists go on the website in advance, and there is the opportunity to set up meetings in advance. And that's a real platform that we provide, which I think is it's real key. They bring everybody who's party to the deal, their actuaries, their attorneys, their claims folks, and they sit down and computers are open, spreadsheets are spread out, and they, work on the numbers and work toward getting the deal actually accomplished. So, certainly, hopefully contributing to the success of the industry and many of the transactions that happen as well.
Yeah, no, absolutely. Absolutely. It's a great help. And you know, I suggest that anyone listening to this go out and take advantage of the resources that Carolyn and Eric make available, because you can get it from an unbiased perspective also. So it's definitely very helpful to both people looking for a solution and to us. It raises the recognition and the reputation of the industry overall, so that's great.
Good. Well, I was going to say, Nick, do we have any questions? I was going to I know time-wise we're about wrapping here.
Sure. Perfect. Thank you for that both again. Yeah, we've got a few questions that have come in. So we'll just start with the one from Hank there. I told you if you put your name on it, you'll get priority. So do you expect that capital will become an issue on the buy side? More capital questions we've got coming through. And would this lead to higher prices? And would you recommend do a deal sooner than later?
Yeah, that's a very good question. As we've seen, capital is definitely a bit of an issue. I think it's getting better where it is right now. If you would have asked me a month ago, there are a lot of traditional capital providers that were dealing with their own issues in terms of if they had equity market exposure. One of the benefits we have on the runoff side is that we really have a non-correlated asset class to the equity markets, and a lot of investors like that from a diversification standpoint. That being said, the yields are definitely not helping. In a higher yield environment, we're obviously able to price things a little more attractively. But overall, I do not think it will lead to significantly higher prices based on the current environment. Now, again, like every single disclosure, I guess, on investment performance, you know, past results aren't necessarily indicative of future performance, right? So as this market changes, everyone's going to have to adapt. And would you recommend doing a deal now rather than later? That really comes down to what the need is. I do expect that later in the year, there is going to be a lot more demand for a transaction. So it's really going to be the bandwidth of individual providers in the industry as a whole. So if someone recognizes now that there is a need for capital, I'd say at least start looking into it to see what sort of timeline there is.
Excellent. You also mentioned that, so why was the front willing to take less collateral from you guys than was required by the capital? We've got a quick answer for that one?
Yeah, I mean, realistically, it's, and I think you mentioned this before, dealing with a lot of industries that don't have insurance expertise and start a captive for various reasons. We have established relationships with the front companies, and they recognize the runoff expertise that we have, and that we are a stronger counterparty than a typical captive holder. Now, I wish I could say that there was a huge difference in less collateral, but even as Paul said before, there is a significant collateral requirement for runoff providers.
Sure. Michael Douglas popped in with a second question. So is there benefit to the purchasing company of a captive being in one domicile over another? So I think the case study is that, I presume it was Cayman, was it, as opposed to Kentucky?
Correct.
Yeah.
Correct.
Other than something in Bermuda, which we're referring to the BDA. So is there changes?
Is there a benefit of purchasing a company of a captive being in one domicile over another? So it really will depend. In terms of jurisdictionally, we have good relationships with both of them, and Cayman and Bermuda also talk. So for that particular example, that was easy. If we're talking about with a true acquisition versus innovation, there may be tax benefits, but that really depends on the the tax structure of the current owner and how we can satisfy that.
Yeah. And no one forms a captive just for tax, right?
Yeah.
So you guys purchased at the end of last year, I think you purchased a captive, it's an ag cap, which is a group captive of agricultural businesses out of California. Are there any significant changes in how you have to perform for groups over single parents? Any other responsibilities, reporting, anything like that?
No, because from that perspective, we're basically taking all of those group members out, and then we're dealing with the front company. So whether it's a single captive or a group captive, the mechanics of the transaction are the same. The result of the transaction is the same. It's really just going out and making sure you're satisfying all the needs of all those individual group members to make the transaction successful.
Perfect. Well, listen, I think we'll have to call it a day there. As always, we don't tend to get through all the questions. Again, thank you, Eric, for your involvement. And should anyone want to get hold of Eric or his team, again, details on the screen. And as before, you can pick up details. Carolyn, a huge thank you for your time and effort and willingness to join us. And if anyone needs any details from AirRock or have any inquiries, please either get in contact with us. We'll happily introduce you to them as an association. They do some brilliant stuff. So this time next week, we've got Beecher Carlson hosting an event, which will be looking at the risk financing, and I think they have Cummings and the Intercontinental Hotel. So that should be fascinating with Pete Krantz talking about there. And then unusually, I'd like to note that this Thursday, outside of our normal Tuesday slot, we had a question mentioned the BDA, the Business Development Agency of Bermuda, are hosting one looking at the future of captives and innovation. So that one's on the 14th of May, not the usual Tuesday slot. And then into the future, we've got clearly SECA, which you mentioned, Carolyn, which is not the Californian insurance.
I know that.
It's the Captive Insurance Companies Association,
Right.
and many will know Dan Toll, and they hosted one. And that's looking at diversity. So that'll be, that's a really key issue. It gives us a little break from COVID for once. And I think looking at one of the really long-standing and important futures of both the next generation, diversity through particularly women and their campaign and program they've got there. So I'd like to thank Fleming Ree again and R&Q as our sponsors. We'd love to see you this time next week, and of course this Thursday for the Bermuda one on regulation and innovation particularly. So on that note, I'd like to thank everyone. I wish you all a good day. Thank you. Goodbye.
All right, thanks everyone. Bye.